Welcome to the Milken Institute studios. We're here this morning with Komal Sri-Kumar. He is the Chief Global Strategist at Trust Company for the West, and fortunately for us, he is also a Senior Fellow at the Milken Institute. Good morning, Sri.
Good morning, Jennifer.
Good morning. We're here to discuss the economic situation in Europe and the measures that they're taking to address the many issues that they have there. So specifically, 2 weeks ago, the European Union agreed to a 750 billion euro aid package. On Monday, the ECB bought 16.5 billion euro in bonds to try and get some liquidity into the credit markets. And this morning, the German parliament approved their share of that aforementioned 750 billion euro aid package. Are these steps in the right direction? Are they going to work? What's your...
There are two problems, Jennifer. First of all, Greece has a solvency problem. It does not have a liquidity problem. What Greece requires is a reduction in the level of its debt. And what the European powers are proposing is to add on to the debts of Greece and Portugal and Spain. And so this is similar, I say, to saying you have a California homeowner and he or she has a $1 million mortgage and $800,000 is the value of the house. Right. It's underwater.
Sure.
And the bank decides to give that person another $1 million loan when that person can't pay even the original amount. What the person requires is really a reduction in the level of the debt to a way in which he or she can continue to service it. The second issue is, as you talked about the 750 billion, of that 440 billion euros are going to come from the Eurozone powers.
Right.
They have to raise money in the markets to pass it on. And if Spain or Portugal and Greece, God forbid, all of them got into trouble at the same time, it's going to be very difficult to persuade markets to lend that money to that special purpose vehicle to pass it on to Greece. That's a big issue here. And they are looking for 250 billion euros from the International Monetary Fund. And that amount is not a grant. It is not even given for sure. It depends on timely disciplinary following of all the policies. And if that doesn't happen, the whole thing falls apart. So those are the two different issues. One is it requires a debt reduction, and second, whether this plan is really going to come into being.
Can you talk a little bit about the basics of the euro market and how it's been working and the debt issues specifically? I know you brought some figures for us to look at.
Right. As we point out in chart 1, Jennifer, we have the euro, which has depreciated quite significantly in recent weeks. It's had some strength yesterday and today. But that notwithstanding, the euro is massively weaker than it used to be before. But it wasn't always like that. If you look at slide number 2, for instance, and you see all the improvement that has taken place in the Eurozone, the debt issuance in terms of euros rather than US dollars has shot up with the coming into being of this currency. Because obviously, it is a lot more acceptable for a debt purchaser to have the debt denominated in euros rather than in German marks or French francs, because this is clearly a currency over a much broader region. So those are the positives. But I think the negatives more recently, which is coming into play, is something that we point to in slide number 3. Many of the fiscal deficits of countries have been out of control. According to the agreement, it shouldn't be more than 3% of GDP. But it is more observed in violation rather than in the adherence. And so that, I think, is again a big issue that we have here. And that's the reason why, as we look forward, you look at the IMF forecast for global growth, and we are looking how the world is likely to do in chart number 4, those numbers are not likely to come through at all in reality. And that's the big concern.
So the measures that they're taking, you're seeing, are not going to work in the way that they are hoping. So what do you see, given that they are moving forward with these measures, what do you see happening?
What I see happening is perhaps this is the best scenario, or the best case scenario would be to go through for 1 or 2 more weeks. Maybe the euro sinks one more time. The stock markets are dragged down, both in Europe and in the United States. And when that happens, the powers decide that, hey, this is not going to work. We have to do something different.
Okay.
And the corrective mechanism involves saying to Greece, for example, or it may involve Portugal and Spain as well, we are going to reduce your level of debt. Maybe you need to pay only 85 cents on the dollar or 80 cents on the dollar.
Okay.
That to you is a concession, but we are going to monitor your fiscal position in future and make sure that that continues to work properly. If that doesn't work, the negative case would be to say, well, some of the marginal countries may have to be dropped out of the Eurozone. We have to reconstitute the Eurozone with greater fiscal discipline, and we will be waiting to see which way we are going to move.
Well, many people here in the United States, we look at it, we read the news, but it seems very far away from us. Tell us how it's not very far away from us and what we here at the Milken Institute understand as a very interconnected global economy. Let's talk about how that is going to impact us in the United States.
That's a very good question, Jennifer. What's happening here is that we are having a worldwide increase in public debt or sovereign debt. Many of these countries had a problem with the private debt being excessive in 2006, 2007.
Sure.
And the government took it over, not only in the United States, but also in many European countries. Suddenly, you find these European countries have lost their credit standing because of the buildup in debt. The second problem here is that the European countries, we used to think of them all as being of the same level of risk because they had the same currency. And that we find is no longer the case, because the interest rate that Greece would have to pay is massively higher than what Germany would have to pay. When that happens, the next move is going to be not only an economic weakening in Europe, but also a slowdown in our exports to those countries. That's one transmission mechanism whereby we start to suffer in the United States. And the second way is that European banks are big lenders to these so-called troubled countries.
Right.
And the US banks have a big exposure to the European countries. And the so-called LIBOR, or the London Interbank Offered Rate, which is used by banks to lend to each other, the 3-month LIBOR rate in dollar terms has practically doubled over the last 3 months.
I saw that.
And that to me suggests, while we are nowhere near the September 2008 levels, that there is clearly, if not a panic, at least growing anxiety in the interbank market. Why is that negative for the United States? Because that in turn is going to mean that the banks are not going to do much lending to the private sector, and that always crimps economic growth.
Well, on that happy note, we'll be looking forward to having you again in the studios, but thank you so much for your time.
Thank you very much for being here, Jennifer.
That's it.